Hey guys, today we'll be covering liquidations. Cuban's Edge obviously released simulated liquidations and liquidation candles. Simulated liquidations is obviously the attempt to give you liquidation data within TradingView, and then liquidation candles is the logic that the liquidations where it's placed within the candle structure, which is quite interesting and quite useful. You can see like where it's highlighting bottoms as well as tops, for example. And once again, this isn't an entry exit tool. This is to give you confidence to your trades, and I'm going to go over statistics to help you guys cover that. So yeah, this is a liquidation tool brought by Cuban's Edge, and we're going to break it down. So just a quick thing, if you're wondering what my settings are here, I've disabled the directional bias because I quite like using just general price action to determine which side's likely to be liquidated, but I've left it on this side because it can be still kind of useful. And then I've disabled medium licks because if I turn them on, it's useful, but it shows a little bit too much, and for the purpose of this video, I want to keep it like very, very simple, very easy to see what's going on, right? And so if you notice, by the way, as I scroll back and forth, the data is changing. That is just because the data changes based off the amount of information you wish to load. So I've made it so we can have as much data in history as possible, so when you scroll back, you have more data. So look, you see there's nothing, it will load in, just give it some time. But one thing to note is once you're on the rightmost bar, so these bars here, and these are all set in stone now, until you scroll back some more, then more will load in. If you see things change in history, it's not going to change in real time. So when this was being printed, like for example when the chart was here and this started to roll through, that was exactly as the data should be. So if I come all the way here, these bars that are printing now are exactly as they will be, and they won't reprint, so you don't have to worry about that. Once the bar closes, so let's say this bar was still printing, once it's closed, that's exactly as the data will be. So yeah, now that that's covered, I want to give you guys some statistics and some logical breakdowns into how you can use this as confidence. So one of the things that many people will know is liquidation hunting. As you move down and we start liquidating long positions, they've in theory been hunted. And once they've been hunted, we then can tend to move up. And that's exactly what this indicator is showing, right? We've moved down, hunted longs, we started to move up, hunted some shorts, not a lot of shorts, but hunted some shorts. We moved back down, hunted a lot of longs here, you can see with these big circles coming in, and you can see the giga licks, as I've called it, the giga positions, they've been hunted. So once again, we start to trend up, right? The logic behind that is once they've been liquidated, we can use their basically their L's, their losses, and we'll move against them in the direction that they wish to have been in. So it's funny. So you're thinking, cool, these guys are going long. Let's ruin their position first, and then we can make the move. That's the way it basically works. And just a heads up, by the way, this is usually used on the lower time frame, and this was built for the lower time frame. I don't advocate for using liquidations on a high time frame. I think your higher time frame bias should be based off of general price action and other indicators, like for example asterisk bar. I wouldn't use liquidation tools on like the daily time frame. I personally wouldn't do that. But yeah, so now how do we know that this works? Well, I've got some statistics to show you guys, and just a quick note as well before I forget. I believe this what's the name, Bitcoin Trading Challenge. I almost said BTC Wisdom, you know, that I think was charting Bitcoin Trading Challenge. Yeah, this is from a video he made a long time ago. I remember watching it a long time ago, and Dad just wanted me to add liquidations to TradingView, so like very long later I did eventually add that in, and we have that here today. This tool, very useful tool. You know, these are all liquidations, just in case anyone wants to see it in its default settings. Here's how it will look when it loads on BTC, and then let's put it into, I like having it in this mode just because this just makes it easier for me to like determine it in my head. Okay, cool, we've moved down a while, these are definitely long links, right? That's how I see it anyway. So what do these statistics show us? So let's say he puts in a threshold of I don't know, 500,000 USD, for example. These are just example values, right? It's found 101 occurrences where within the full sample of 500,000 USD liquidations. And what does this show? On average, after a 5-minute period, we gained 0.04% in price, and then in 15 minutes we went up 0.12%, and in 25 minutes, and so on and so forth. And as you can see, on a larger scale, it becomes almost irrelevant. And the reason for that is, like I said, if it's on a general trend, like a long-term trend on a higher time frame, you don't want to fight against that like hourly, daily kind of move. You kind of want to go with it, and I'll explain that as well. But in a general sense, liquidations tend to result in the side that's been liquidated, they end up being right after they've been liquidated, and that's the funny bit, that's the fun bit about it, right? You're kind of like hunting these people, and once they've been hunted, you're like, okay, cool, now I'll buy. It's like that whole meme in quotation marks, I'm buying your stop, so I'm buying your liquidation. Like that's the whole point. Like once you've been invalidated, now I'm gonna be right. Like it's that kind of vibe. And so yeah, so this is proof that in these 101 instances, and you select the date range. I believe his date range was like a week or something like that. And in that date range, it's proved that once these liquidations have occurred, we tend to move up. So longs have been liquidated, we've moved down. They've been liquidated, we tend to move up. So if we look at here, longs were liquidated here. You can see that here. We tend to start to move up. Like keep in mind, simulated liquidations is pretty good. Its directional bias could be improved, and that's going to be worked on soon. Then that's the reason why I have this in the like singular mode. Let me just disable medium licks. I can see there's a lot going on here. Might be easier for you guys to see. Like you see, like these are big licks. So this is big licks and giga licks all printing at the same time. So longs were liquidated here, we tend to move up. And longs were liquidated here, and we tend to move up. That whole thing, and proven by these statistics. So there you go. That's your statistical confluence. And so I'm going to break down how you can use this confluence in your trading, for example. So let's say you're someone who uses the market profile as one of your trading tools, for example, right? And let's say this is a value area low, maybe a naked value area low, for the sake of it. Naked value area low, and and let's say this is roughly your naked value area high. So let's say this is your market profile, value area low, value area high, right? You know that once we trade, I believe it's around 80%, don't quote me on that, but I believe it's around 80%, that once we trade back into value, we tend to trade towards the other side. So if we've gone to the value area low, and then we trade back in within the value area region, we tend to trade towards the value area high. Let's say you've got that 80% in your head and you're like, okay, cool, this is a reasonable trade to take. Well, how do we avoid those 20% regions where we could be wrong? We can use the liquidations, knowing that on the long side, when liquidations have occurred, we tend to move up for at least 25 minutes, right? So we've come down into this value area low, we've seen some liquidations. We're going to tend to likely move up again after a short period of time. And a good example of that is this one, where it happens pretty much almost instantaneously. This one, it happens, and then we had to lick again, and then we started to trend up. But a great example is, let's say this one, let's say this was the naked value and the naked extensions this way. We've come down, we've tapped, we're going to tend to trade up, right? Like that's the whole view. Like you got the 80% value, trading within value to trade towards the upside. But then you've also got the idea that liquidations tend to increase the likelihood of us moving up again. So using both in confluence is how you will use this for your trading. You're not meant to use liquidations as signals. It's never going to be a signals tool. It's not meant to be, oh, these guys are liquidating, let me just enter a position blindly. But you can see in examples like here, we start to move down a bit, shot up, liquidated all these guys, and then plummeted back down, liquidated all these guys, and then shot back up, liquidated all these guys and plummeted back down. Obviously not massive movements here, but movements nonetheless on the low time frame. And once again, liquidated all these guys who probably took shorts in this region, spike above all of them, take out their stops. You can see we go above this, we take out all their stops, get liquidated, and so on and so forth, and then we start to move back down. It's that whole idea that these percentages of probability increasing your likelihood of your trade tool of working. You're not meant to just blindly use these. So if you have for example a trend, you're meant to play the trend, or if you have ranges, you can use them in ranges. So I'll explain that now. So let's say you're someone who's trading, well, the value area was a good example of a range, but we'll break it down even further. Let's say this is your range, right? And in ranges in general, we tend to do this. If we're going to keep doing this, right, how are you going to add confidence to your trade? So we've moved up, liquidated short, enter here. Move down, liquidated longs, enter here. Obviously, it's not, you're not going to get top and bottoms. I'm just saying as an example. Maybe we move up, we don't liquidate anyone. Maybe that's when you don't take a trade. Maybe you're thinking we're going to keep going because no one got licked yet. But then we don't lick anyone. Maybe you don't take that trade. But it's just the whole point of adding greater probability when there's been licks. So these circles represent licks. No one was licked there, so you didn't take the trade. No one was licked there, you didn't take the trade. Loads of people were licked here because we went below the stops, for example. You take the trade once we enter the range again to make sure we play towards the range side. So you enter around here and you play towards the upside, because in ranges the probability of us playing the range is more likely to work out than trying to play a breakout. So once we get here, there's no point of going long here. You are more than likely going to be stopped once you go back inside the range, right? Like, it's better to play the range when within range. That just makes sense. But then using the liquidations as complement is going to help you more. And that's just basic knowledge. Anyone and everyone should have been able to figure that out. But it's just to give those people who haven't done this before, haven't used liquidations, the idea of when to use them. So most people will know how to use them in ranges, but how do you use them in trend? Well, that's quite simple as well. So let's draw a trend real quick. So let's say this is an uptrend, right? And once again, circles represent liquidations. So let's say we've got a short liquidation here. Let me make that. Well, green is the correct color, but you know what, I'm gonna make it red just for keeping it separate. So let's say we get these guys liquidated, right? We liquidate here, and we're in an uptrend. You're not going to want to short the uptrend, because obviously one, we're in an uptrend, so that doesn't make sense. You're playing against the trend. And two, even though we might move down, let's say this move down was, I don't know, $50, right? As you can see, this move up is significantly larger than this move down. The same move here. That's how uptrends typically work, right? The move downs are going to be weaker. So yeah, you might have some confluence of, oh, this might be the top for, and maybe you have another indicator for some reason that's telling you, oh, this is the top, right? Why would it make logical sense to take this trade when the probability of the next liquidations occurring here of longs, we're going to make this blue because it's going to get like a bit too confusing. Let's say this is liquidated longs, right? Once longs are liquidated, we tend to move up again. This has a greater risk to reward, like in your favor, than this does. As you can see, by the difference in the scale. Maybe this is $50 down and this is 200 up. You're going to want to take the 200 up. That's the logical option. Now, that's not to say you can't use it in trend against trend. For example, once we're like, maybe we're doing some sort of blow off movement where we're like seriously overextended, and you can use your understanding for overextension based off of something you want to use. Maybe we've done something like this. Maybe that's just an example. And then you have like, okay, typically we tend to stay within a 5% range from the mean, and let's say this is the mean. This is just a very basic example. I'm probably not drawing this the best. And then this is like a 10% move, and then we saw a fuckload of liquidations as well. Then you can use it potentially for mean reversion. You're like, okay, cool, we're like super overextended. Returning back to mean is also around like a $200 gain. I will take that risk to reward. Like then that makes sense. But for the most part, if we're within mean and the returning back to mean is only going to be like $50, or just below mean is going to be like $50, that doesn't make sense. So for the most part, you don't take these short liquidations. You might take the overextended liquidation, but you use the long liquidations in your trading to give you the opportunities to buy dips of where basically, to keep it quite fair, idiots got liquidated, right? Like people on like 100x, and maybe not necessarily idiots, but people who tend to like long the top, so they're longing here, they're getting fucked there, right? Like that's just the whole point. Like it's basically PvP. You see people die and you're like, cool, easy pickings. Like I'm gonna join this zone here and long here, right? Like that's just basically how it is. And it's the same for the inverse, right? We start trending down. Well, this is like a wonky as fuck. I don't know the best way to draw it. But yeah, we start trending down. You can see these pips up here. And let's make this one red this time. And pips up here. You see these guys getting liquidated on their longs, right? They're not, if you try to enter here for a long position, because you know after longs have been liquidated, we typically move up a little bit. We're less likely to have success because the downtrend is where most of the money's being made right now. So most of the money is going to be made entering again with shorts liquidated, not longs, because you know once they've been liquidated, we can now move down, and the probability of it playing out with a better risk to reward is better for you because trend is in your favor. And that's literally how you use this. You use it as complements. So you use it as, for example, in your ranges, value area ranges, for example. You use it in your trends, and you use it as complements. Don't use it as an entry exit signal. Now, how does the candle structure one work, and how is it better for you? Well, it's quite simple, really. It's similar to the whole being able to point out where they've been liquidated being helpful. So if you can see they've been typically wicked out, that's usually the best place to enter. These areas where it's more towards the lows. You can see it happen quite a lot. You saw it back there in the earlier example, and just let's indicate a load. And you can see it here, all within wicks. Typically it's going to help you because once it's within like the bar, it's typically running through them. It's trying to get as much liquidations as it can in like a sort of cascade. And once again, the wicks, but it's not a signal. So if you just see a wick, don't just blindly take the position. It is a confluence tool. So maybe you have some support here, or maybe you have, I don't know, a naked POC or something like that. That will help you, or value, or like a Cuban's reversion bands area, for example. Those are the opportune moments for you to use it. Now I'm going to show you guys an interesting example that's kind of contradictory to everything that's been said, but I want to show you guys so you guys can prepare yourself for all case scenarios, right? Long liquidations has proven our thesis that once liquidated, we'll tend to then move up. So longs got liquidated and we moved in the directions that longs wanted the whole time. Boohoo, sad for them, right? Shorts liquidated shows a different picture. It's quite interesting. And I have a reasoning for why I believe this is the case. Everyone knows liquidations tend to work quite well, but it didn't work great in this instance of the backtest. So let's say he does the same thing, short liquidations, 500k. You're thinking, cool, we're going to move down on a 5-minute average, but we moved up. 15-minute average, but we moved up. 25-minute average, but we moved up all the way to the 80-hour average is the first time we start to move down again. So why might this be the case? Why is it so on the short side this didn't work? Well, I think the framing of context matters in this instance. This video, if I recall, was taking somewhere around, it's quite interesting. So this is just my belief as to why it didn't work in these cases, because the back testing data, I believe he did it around a week, and if I recall correctly, it was around December, sometime here. Alright, so as you can see, we're in like a global uptrend, right? Where we're March crash all the way to our cycle peaks and so on and so forth. But you might be wondering, oh, why did we not manage to trend up? I mean, why did we not manage to go back down even during a small downtrend? Like obviously in the global scale, this is a massive uptrend, but on the 5-minute chart, we've seen some liquidations. Why didn't we go down? If I had to guess, my reason being was there was such an overwhelming amount of demand that even in this really small downtrend here, as you can see, look at all these big daily green bars that follow. If I had to guess, all of these liquidations that were being liquidated on the short side were genuine attempts to give us a breakout. So maybe we were liquidating. Oh, why is it drawing like this? Is magnet mode on? No, it's not. Okay, well, we're gonna go with it. Oh, it's because I was zoomed in. Okay, yeah, that works so much better. We draw these again. So yeah, we might have been trending down, but I believe these downtrends were very small in comparison to the global trend up. So when there was demand, you know how usually when I was like, oh, we're trending down, it's going to be like this and it's going to be a small pip up. I believe the pips up were bigger than expected because it was a genuine attempt to reverse the small downtrend that we're seeing in order to kickstart the bull market that we just experienced, right? So I believe that's the reason. So obviously frame it in context. If we have a very big trend shift, and in this case it was a start of a massive bull market, right, or like in the midst of the bull market, massive bull market, you're not necessarily going to want to blindly go against that. Now of course this was still a couple days, so there probably were short opportunities, but you had to be a bit more careful. This was like a bull, like this isn't just, oh, we started to cycle up afterwards. This is like in the midst of a parabolic run that started like just before, so you could tell the demand was there to push us all the way up to fucking here before we had like a reset and created some sort of range and liquidity. I guarantee you there was people just liquidated here on the short side, which is rough. But this is what I'm saying, like play the trends, contextualize everything, look at the different time frames, figure out what's going on, and then can you take your trades. Then does it make sense to go with liquidations as confluence, not a signal. Anyway, I hope you guys enjoyed. If you guys are wondering why liquidations isn't showing, there's not enough data given for us to go all the way back, but you can see it does prop up it here and there. But yeah, I hope you guys enjoyed. I found this useful to make. It helps just to explain everything all over again, so people can understand, because I know a lot of people have been, so many people have been asking, Spaceman, how do I use the liquidation tools? Well, I hope this helped. The ending of the video got cut off. So yeah, if you guys wanted to get a chance to use these tools, it's over at cubansedge.com. As well as the Discord is something that you guys would want to verify your account with, so you can buy with your email. But if you get a chance, either buy with a Discord account connected, or buy with your email and then connect it afterwards. You get access to the members chart and the trading channel. These things will be more active as well soon, so we hope you guys definitely join us in the Discord too. And if you want to just pop into the Discord, go for it. We do some free drops every now and then too, but definitely come check us out over at cubansedge.com. It's probably gonna have ridiculous amount of updates like really soon, so I do think you guys should tune in. But yeah, see you guys next time. Bye.